Ever feel like the tax system is rigged against you while the wealthy keep getting richer? I know how frustrating it can be to watch others prosper while you're left picking up the tab. But what if you could turn the tables and use the same strategies they do to safeguard your income? In this video from Future Finance Lab, we're unveiling 15 powerful tax secrets the rich leverage to legally retain more of their wealth. And these are tactics you can start using today. By the end, you'll not only understand how these strategies work, but also feel empowered to apply them ethically and effectively in your own life. Ready to take control of your financial future and stop leaving money on the table? Let's dive in. 1. Offshore tax havens. The allure of offshore tax havens, minimizing tax liabilities. Offshore tax havens are jurisdictions known for offering low or zero tax rates, attracting wealthy individuals and corporations seeking to minimize their tax liabilities. These havens also provide financial secrecy laws that enable people to hide income, shield assets, and defer tax payments, sometimes leading to ethical concerns. These are countries where the wealthy stash their money to avoid paying taxes. These places, like the Cayman Islands or Bermuda, often have very low or no taxes, making them attractive for tax avoidance. Navigating the offshore landscape, strategies for tax reduction. The wealthy utilize offshore accounts or establish shell companies in tax havens to legally reduce their tax obligations. Although this can be part of legitimate tax planning, it often overlaps with aggressive tax avoidance or even illegal tax evasion when used to conceal assets or income. The line between legal and illegal practices can be blurry, making these strategies controversial. Tax havens, legal loopholes, or unethical dodges. While using offshore tax havens is technically legal, the ethical implications spark heated debates. There is often a fine line between legitimate tax minimization and tax evasion, as some tactics exploit grey areas in international law. For instance, the Pandora Papers exposed over 300 politicians and public figures who had hidden wealth in tax havens, sparking global outrage over practices that deprive governments of revenue. From banking secrecy to modern tax havens, a historical overview. The concept of tax havens emerged in the early 20th century, when countries like Switzerland introduced banking secrecy laws. Today, prominent tax havens include the Cayman Islands, Bermuda, and Luxembourg, where secrecy and favorable tax laws attract global wealth. The practice has evolved with complex legal structures that make it difficult for tax authorities to trace funds. The cost of tax havens, lost revenue, and global consequences. The Tax Justice Network estimates that between $21 trillion and $32 trillion is held in offshore tax havens globally. This lost tax revenue equates to the combined annual budgets of the world's top 20 military spenders, highlighting the significant financial impact on governments. Developing countries are particularly affected, losing approximately $200 billion every year due to tax avoidance strategies linked to tax havens. Notorious examples: how the wealthy use offshore accounts. Vijay Mallya and the Caribbean. Vijay Mallya, the former chairman of Kingfisher Airlines, notoriously used Caribbean tax havens to shield assets from creditors and evade taxes owed in India. His offshore accounts enabled him to move substantial wealth out of reach, showing how such strategies can be misused to avoid legal obligations. Anil Ambani and offshore companies. Billionaire Anil Ambani was reported to have links to offshore entities in the British Virgin Islands. These arrangements were used to manage large sums of money outside India, revealing how some of the country's wealthiest individuals employ offshore structures to reduce their tax liabilities or maintain financial secrecy. Apple's double Irish with a Dutch sandwich strategy. Tech giant Apple utilized a complex tax avoidance scheme known as the double Irish with a Dutch sandwich, routing profits through Ireland, the Netherlands, and Bermuda to drastically lower its tax bill. This maneuver, while legal, saved Apple billions in taxes over several years and prompted international calls for closing such loopholes. Pro tip: for those curious about offshore opportunities, start by consulting a financial advisor about international diversification options that are fully compliant with Indian tax laws. The tax gap: how offshore havens affect everyday taxpayers. For regular taxpayers, the use of offshore tax havens by the wealthy and large corporations creates a disproportionate tax burden. Ordinary citizens who cannot access such sophisticated tax-saving mechanisms end up shouldering more taxes. This disparity exacerbates wealth inequality and limits government spending on essential services like healthcare, education, and infrastructure due to reduced tax revenue. Feeling left behind, the emotional impact of wealth disparity. Imagine working hard, diligently paying your taxes, only to find out that some of the wealthiest individuals and largest corporations can legally sidestep their tax obligations. This reality is infuriating for many, as it seems like the rules are rigged in favor of the rich. The International Monetary Fund, IMF, estimates that tax avoidance strategies involving havens cost developing countries around $200 billion annually, funds that could significantly improve living standards for millions. Tax havens, smart strategy, or unethical evasion? We want to hear from you. What do you think about offshore tax havens? Are they a smart tax strategy or an unethical way to dodge responsibilities? Share your thoughts in the comments, and let's discuss how we can create a fairer tax system for everyone. 2. Tax deductions and credits. Understanding deductions versus credits. What you need to know. Tax deductions and credits are provisions in the Indian tax system that allow individuals and corporations to reduce their taxable income. This effectively lowers the amount of tax owed. Deductions reduce the overall income subject to tax, while credits directly decrease the tax liability. Deductions reduce the income you're taxed on. Credits directly lower the taxes you owe. The wealthy take advantage of these by investing in retirement funds, renewable energy, and charities to reduce their tax bill. Smart tax planning, leveraging deductions and credits for wealth. Wealthy individuals often maximize tax deductions by investing in specified instruments like Public Provident Fund (PPF), National Pension System (NPS), and others. Similarly, tax credits for investments in renewable energy or donations to charitable organizations can significantly lower tax bills. This demonstrates how these strategies can be utilized for effective tax planning. Tax deductions, legitimate benefits or unethical exploitation. Using deductions and credits is legal and encouraged by the Indian government to promote savings and investment. However, the misuse of these provisions, such as inflating expenses or making non-qualifying claims, crosses into unethical territory. The balance between legitimate financial planning and aggressive tax avoidance is crucial. The evolution of tax deductions and credits, a historical context. India has a long-standing framework for tax deductions and credits, outlined in the Income Tax Act, 1961. Recent reforms, including the introduction of the new tax regime, have aimed to simplify these provisions while still incentivizing investment in various sectors. Lost revenue. How tax deductions impact government budgets. According to the Ministry of Finance, the government loses approximately 2.5 lakh crore in potential revenue due to various tax deductions and credits claimed annually. This figure underscores the importance of understanding and utilizing these provisions while ensuring compliance with tax laws. Case studies. How India's wealthy use tax deductions effectively. Mukesh Ambani and investments. Mukesh Ambani, chairman of Reliance Industries, has utilized tax deductions through substantial investments in renewable energy. By channeling funds into clean energy projects, he not only contributes to sustainable development, but also significantly reduces his tax burden. Sundar Pichai's charitable contributions. Sundar Pichai, CEO of Google, has made significant donations to various educational and health initiatives in India, claiming deductions under Section 80G. His contributions highlight how philanthropy can serve both social good and tax-saving benefits. Real estate investments. Many wealthy individuals in India invest in real estate to benefit from deductions on home loan interest and principal repayments. This strategy allows them to reduce their taxable income while simultaneously growing their asset base. Pro tip: keep a log of eligible expenses like healthcare, education, and charitable donations. Use tax-saving instruments like the Public Provident Fund (PPF) or the National Pension System (NPS) to reduce your taxable income. The complexity of tax deductions, a burden for the average taxpayer. For the average Indian taxpayer, the complex web of deductions available can feel overwhelming. This often leads to confusion about maximizing benefits. Meanwhile, High-income individuals and corporations that expertly navigate these provisions can reduce their effective tax rates significantly. This places a larger financial burden on middle and lower-income groups. Frustration and inequity, the emotional side of tax deductions. Imagine struggling to make ends meet while watching the affluent use deductions and credits to significantly reduce their tax bills. This unfairness can be disheartening, particularly when essential public services suffer due to revenue shortfalls. Every 1 crore not collected in tax revenue could have funded schools, hospitals, and infrastructure projects crucial for the country's development. Tax deductions, fair incentives, or favoring the wealthy? What are your thoughts on tax deductions and credits in India? How can we ensure that the tax system is equitable for all? Share your views in the comments below, and let's discuss how to make tax laws work for everyone. 3. Family trusts. Understanding family trusts, a tool for the affluent. A family trust is a legal arrangement in which assets are held and managed by a trustee for the benefit of family members. In India, family trusts are increasingly used as a means to manage wealth, protect assets, and optimize tax liabilities. A family trust allows wealthy families to protect their money and assets while reducing the amount of tax they pay, especially on inheritance. Family trusts explained. Mechanisms for asset management. Wealthy families establish trusts to control how their assets are distributed. This often leads to reduced inheritance taxes and provides a way to shield assets from potential creditors. The trust structure can provide significant tax benefits, making it a popular strategy among affluent families. Family trusts, legitimate estate planning, or asset hiding. Family trusts are legitimate tools for wealth management and estate planning. However, misuse can occur when individuals attempt to hide assets from creditors or evade taxes. This raises ethical questions about transparency and fairness. The Indian Trusts Act, legal foundations of family trusts. The Indian Trusts Act, 1882, governs the establishment and operation of family trusts. Recent amendments and regulatory frameworks have made it easier for individuals to create and manage trusts. This reflects a growing awareness of the importance of estate planning. Growing wealth, the rise of family trusts in India. A report from KPMG indicates that around 3,500 family trusts exist in India, with assets exceeding 1 lakh crore. This growth demonstrates a shift towards sophisticated wealth management strategies among India's wealthy elite. Tata Trusts. The Tata family established the Tata Trusts, which manage a vast array of assets for philanthropic purposes. This setup allows the family to support numerous social initiatives while also managing tax liabilities effectively. Wadhawan Family Trust. The Wadhawan family of the DHFL Group created a family trust to manage their real estate and financial investments. This ensures smooth succession and reduces estate taxes. This approach has helped in preserving wealth across generations. Infosys Founders Trusts. The founders of Infosys, including Narayana Murthy, have established family trusts to manage their significant wealth. These trusts facilitate tax planning and support charitable causes, exemplifying responsible wealth management. Wealth disparity, family trusts, and the average taxpayer's challenge. The use of family trusts often leaves the average taxpayer feeling disadvantaged, as they lack access to the same sophisticated wealth management tools. This disparity can widen the wealth gap, as those with financial resources can protect their assets more effectively than the general population. Pro tip: explore setting up a simple family trust if you're interested in estate planning. This can protect assets and ensure they are managed according to your wishes. The gap between classes, emotional stories of tax disparities. Consider the challenges faced by ordinary families striving for financial stability while watching affluent families utilize trusts to secure their legacies. The gap between the wealthy and the middle class can feel insurmountable. This is especially true when tax policies favor the privileged, leading to feelings of frustration and helplessness. Family trusts, smart wealth management, or unfair advantage? Join the discussion. Are they a smart way to manage wealth, or a tool for the rich to shield their assets? Share your opinions in the comments, and let's discuss how we can create a more equitable financial landscape. 4. Corporate structures. Understanding corporate structures, a path to tax optimization. Corporate structures involve the formation of various types of business entities, such as private limited companies, partnerships, and sole proprietorships. In India, entrepreneurs and wealthy individuals often use these structures to optimize tax liabilities and limit personal liability. The wealthy set up companies and funnel money through them to pay lower corporate taxes instead of higher personal taxes. They also get business-related deductions. The mechanisms behind corporate tax savings, strategies for the wealthy. By incorporating businesses or establishing partnerships, wealthy individuals can take advantage of lower corporate tax rates and various deductions unavailable to individuals. This strategic maneuvering can significantly reduce overall tax burdens. Legal versus ethical, the debate on corporate tax minimization. Structuring businesses to minimize tax is legal, but some may cross ethical lines by exploiting loopholes. The distinction between acceptable tax planning and illegal tax evasion can be murky, leading to public outcry and demands for reform. Evolution of corporate taxation. India's changing landscape. India has seen significant changes in corporate tax laws, especially following the implementation of the Goods and Services Tax, GST, and the recent reduction of the corporate tax rate to 22%. These reforms aim to attract investment while ensuring compliance. The financial perspective, corporate tax statistics. The corporate tax rate in India has dropped to 25%, making it one of the most competitive rates globally. This shift has led to a surge in new company registrations, with over 1.5 lakh new companies established in 2020 alone. Corporate case studies. Real-life tax strategies. Reliance Industries Limited. Reliance employs a corporate structure that allows it to benefit from various tax incentives while expanding its business interests across sectors like telecommunications and retail. Flipkart and Walmart. When Walmart acquired Flipkart, the transaction involved complex corporate structuring that minimized tax liabilities in India. Such maneuvers highlight how large corporations leverage corporate structures to enhance profitability. Pro tip: small business owners can consider structuring as an LLP or private limited company to benefit from lower tax rates and deductions. The impact on average citizens: increased tax burdens. The sophisticated use of corporate structures by wealthy individuals and large corporations often results in the average taxpayer bearing a heavier tax burden. As the wealthy navigate tax laws effectively, the rest of society may find it increasingly difficult to achieve similar financial success. Corporate privilege, the emotional impact on small business owners. Imagine working tirelessly to build a small business, while large corporations exploit legal structures to pay significantly less in taxes. This inequality can foster feelings of injustice and resentment, particularly when public services suffer due to diminished tax revenues. Business structures, level playing field or unfair edge? Share your opinion. What are your views on corporate structures and their impact on tax liabilities in India? Do you think they provide a fair advantage to businesses, or do they contribute to inequality? Let us know in the comments, and let's discuss how we can create a more balanced tax environment. 5. Capital gains tax strategies. Decoding capital gains taxes, wealth management through investments. Capital gains tax strategies involve methods used by individuals and corporations to minimize taxes on profits from asset sales. In India, long-term capital gains (LTCG) from equity investments are taxed at 10% for gains above 1 lakh, while short-term capital gains (STCG) are taxed at 15%. The wealthy often hold on to investments like stocks or property to qualify for lower LTCG rates, reducing the taxes owed on their profits. How the wealthy minimize capital gains taxes. Strategic savings. Wealthy individuals use strategies like holding assets longer for LTCG rates, offsetting gains with losses, or using tax-exempt options like the Public Provident Fund (PPF) or National Pension System (NPS) to lower tax burdens. Ethics and legality in capital gains tax planning. Using capital gains tax strategies is legal when it aligns with the Income Tax Act. However, aggressive tactics, such as artificially creating losses to offset gains, may face scrutiny and cross ethical lines. Capital gains tax evolution, regulatory changes in India. India's tax framework for capital gains has evolved with GST and changes to income tax slabs, impacting effective tax planning strategies. Capital gains in numbers. revenue and investment trends. As per the Economic Survey of 2022, the Indian government collected 1.45 lakh crore in capital gains tax, marking it a significant revenue source. The number of equity market investors is also rising, underscoring the importance of capital gains tax awareness. Mukesh Jhunjhunwala strategically held his stock investments for over a year to leverage LTCG rates, demonstrating the benefits of long-term investing. HDFC uses its real estate holdings to reinvest gains into new projects, showcasing corporate tax efficiency through reinvestment. Real estate investments. High-profile individuals often hold property long-term, reducing tax liabilities through LTCG benefits. Pro tip: try holding stocks for over a year to qualify for lower LTCG rates, or sell underperforming assets to offset gains. Capital gains and its effects on average citizens. The wealthy leverage capital gains tax strategies to lower taxes, while average citizens may lack the financial literacy or access to similar tactics, placing a heavier burden on lower and middle income groups. Investment in equities. Emotional toll of capital gains advantage. The middle-class investor saving for a home may feel frustration, seeing wealthy individuals pay less tax on gains. This disparity can be disheartening and fuel feelings of systemic bias. Capital gains strategies, smart investing, or unfair advantage. Join the discussion. What are your views on capital gains tax strategies in India? Share your thoughts in the comments. 6. Income splitting. Income redistribution. Family strategies for lower tax burdens. Income splitting distributes income among family members or entities to lower tax liability. High-income earners in India often shift income to family members in lower tax brackets to reduce overall taxes. This strategy allows wealthy individuals to offset profits with losses from other investments, further reducing tax payments on gains. Strategic allocation. Effective tax savings. Wealthy families may allocate assets to spouses, children, or family members to leverage lower tax brackets, reducing the family's overall tax burden. Ethics in income splitting. Legal boundaries. Income splitting is legal if done transparently per tax laws. Misrepresentation or underreporting, however, can lead to legal issues. Legal provisions. Gifting and ownership for income redistribution. The Indian Income Tax Act allows gifting assets to family members, with income generated from these assets taxed under the recipient's name, thus enabling income splitting within regulations. Economic impact. Income splitting and revenue loss. According to the National Institute of Public Finance and Policy, India loses approximately 15,000 crore in tax revenue each year due to income splitting strategies, raising fairness concerns. Case studies, income splitting applications. Kumar Mangalam Birla, chairman of the Aditya Birla Group, uses income splitting by allocating shares of the family business among relatives, optimizing the family's tax efficiency. Small business owners. Many business owners transfer shares to spouses or children, benefiting from lower tax brackets. Investments in minors' names. Wealthy families often invest in stocks or mutual funds under minors' names, lowering tax obligations through the child's tax bracket. Pro tip: consider investing in a spouse's or child's name if they are in a lower tax bracket, but ensure compliance with Indian gifting regulations. Impact on ordinary citizens. Unequal tax burdens. Income splitting often widens wealth inequality, as average citizens lack the resources or knowledge to employ such strategies, placing a heavier tax burden on lower income groups. Family-based tax strategies. Emotional impact. The diligent taxpayer paying high taxes may feel frustration knowing wealthier families can reduce taxes through income splitting, leading to feelings of injustice. Income splitting. Financial strategy or unfair play. Share your thoughts. What's your take on income splitting in India? Does it aid financial planning or worsen inequality? Share your perspective in the comments, and let's discuss a fairer tax system. 7. Tax loss harvesting. Tax loss harvesting, offsetting losses with gains. Tax loss harvesting offsets capital gains by selling underperforming investments. In India, this strategy helps investors reduce tax on profitable investments by realizing losses. The wealthy may donate to charity, not only supporting causes, but reducing taxable income, which lowers their overall tax bill. Mechanics of loss harvesting, cutting tax liabilities. Wealthy individuals often employ loss harvesting near the financial year end, selling underperforming assets to offset gains. Legitimacy in tax loss harvesting, ethical perspectives. While legal, tax loss harvesting raises ethical concerns if done purely for tax savings without an underlying investment rationale. Regulatory landscape. Evolution of loss harvesting in India. India's Income Tax Act allows capital gains offsetting with losses from other sources, supporting loss harvesting as a tax management tool. Insights. Growth of tax loss harvesting. According to CB, nearly 40% of retail investors actively employ tax loss harvesting, illustrating its popularity for tax savings. Examples: loss harvesting in practice. Nandan Nilekani, Infosys co-founder Nilekani uses loss harvesting to manage investments efficiently, reducing taxes through portfolio adjustments. Pro tip: offset gains by selling losing investments toward year-end and track losses for optimized tax benefits. Average citizens and financial literacy gaps. While effective for the wealthy, many citizens lack the knowledge to implement tax loss harvesting, leading to higher taxes and emphasizing financial literacy gaps. Investor frustrations, disparities in tax knowledge. Retail investors, unfamiliar with complex strategies, may feel disenfranchised, seeing others easily navigate tax systems, fueling frustration. Tax loss harvesting, legitimate strategy or loophole? Let us know. Do you think tax loss harvesting is fair game or an unfair advantage for the wealthy? Share your views, and let's discuss making tax strategies accessible for all. 8. Charitable contributions. Charitable contributions as a tax strategy. Giving and gaining charitable contributions involve donating to registered organizations or causes, often providing tax benefits to the donor. In India, donations to certain charitable institutions can qualify for tax deductions under Section 80G of the Income Tax Act. Government bonds and other tax-free investments allow the rich to earn money without paying taxes on it. They're safe investments that grow wealth while avoiding taxes. Impactful giving, how donations reduce tax obligations. Wealthy individuals often make significant charitable contributions, not only to support causes they care about, but also to reduce their taxable income, taking advantage of the deductions available for qualifying donations. Charity for tax savings. Altruism or exploitation. Charitable contributions are legal and encouraged by the Indian government, promoting social welfare and community support. However, individuals must ensure that their donations are made to registered organizations to claim tax benefits. Historical context. Charitable deductions in Indian tax law. The practice of giving has deep roots in Indian culture. The Income Tax Act has provisions for tax deductions for charitable donations, reflecting the government's commitment to encouraging philanthropy. Financial impact. Charitable contribution statistics. According to the Philanthropy in India report, charitable contributions have grown to approximately 70,000 crore annually. High net worth individuals, HNWIs, play a significant role in this growth. Case studies. Prominent examples of charitable contributions. Azim Premji Foundation. Azim Premji, founder of Wipro, has made substantial charitable contributions supporting education and health initiatives. His philanthropy not only impacts communities, but also provides significant tax deductions. Pro tip: donations to registered charities qualify for deductions under Section 80G. Research eligible charities and keep donation receipts for filing. The inequity of giving. Limits for average citizens. While charitable contributions by wealthy individuals often support essential causes, the average citizen may struggle to contribute at the same level, leading to feelings of inadequacy. Additionally, public perception can view philanthropy as a means for the wealthy to evade taxes rather than genuine altruism. The guilt gap. Emotional complexity of financial inequality in giving. Imagine the impact that large charitable contributions can make on society, yet feel overshadowed by the realization that not everyone can give at that level. This disparity can create a sense of helplessness among those wanting to contribute but feeling limited by their financial situation. Philanthropy and taxes, genuinely beneficial or just for savings? Share your perspective. Do they genuinely benefit society, or are they a tool for the wealthy to minimize their tax liabilities? Share your views in the comments, and let's discuss the role of philanthropy in our financial system. 9. Offshore accounts. Offshore accounts explained, a path to tax efficiency or evasion. Offshore accounts are financial accounts located outside of one's country of residence, often used for tax optimization, asset protection, and privacy. In India, some wealthy individuals utilize offshore accounts to manage wealth and minimize tax liabilities. Wealthy individuals open accounts in other countries with low tax rates to protect their wealth and reduce taxes. This strategy often involves secrecy to keep the money hidden from tax authorities. Mechanisms of offshore banking. Secrets of the wealthy. Wealthy individuals may establish offshore accounts in jurisdictions with favorable tax regulations. This strategy allows them to benefit from lower tax rates, asset protection, and confidentiality, effectively reducing their overall tax burden. The offshore account dilemma. Legal loophole or illicit practice. While maintaining offshore accounts is legal, the misuse of these accounts for tax evasion is illegal and subject to scrutiny. Transparency and compliance with both Indian and foreign tax regulations are crucial for lawful operation. History of offshore accounts in Indian wealth management. The Indian government has intensified efforts to combat tax evasion through offshore accounts, implementing the Black Money Act 2015, which targets unreported foreign assets and income. Recent agreements with countries for information exchange have increased pressure on individuals to disclose foreign accounts. Offshore accounts, how they skew tax fairness in India. According to a report by the International Consortium of Investigative Journalists, it is estimated that Indian nationals hold approximately $500 billion in offshore accounts, underscoring the scale of this practice. Case studies. Offshore accounts and tax disparities in India. Wealthy business tycoons. Several prominent Indian business families maintain offshore accounts for asset diversification and tax management, utilizing jurisdictions known for their lenient tax regulations. Investments in real estate. Many affluent individuals purchase international properties through offshore entities, allowing them to shield assets from high domestic taxes while enjoying global investment opportunities. NRI investments, non-resident Indians, often use offshore accounts to manage investments and remittances, taking advantage of favorable tax treatment in their host countries. Pro tip: for NRIs, opening accounts in compliant offshore banks can simplify tax filings. Residents should consult advisors to ensure compliance with RBI and tax regulations. Public impact. Offshore banking's effect on Indian society. The prevalence of offshore accounts among wealthy individuals creates a perception of inequality in the tax system. Average citizens, who may not have the means to establish such accounts, often bear the brunt of taxation, leading to frustration and a sense of injustice. The emotional divide. Perceptions of offshore accounts and tax fairness. Imagine working hard to provide for your family while knowing that wealthy individuals are using offshore accounts to evade taxes. This disparity can foster feelings of anger and betrayal, particularly when essential public services suffer due to lost tax revenue. Understanding offshore accounts. Are they justifiable? Share your thoughts. What do you think about offshore accounts in the context of Indian tax laws? Are they a legitimate financial strategy or a tool for evasion? Share your thoughts in the comments, and let's discuss the implications of offshore banking for our society. 10. Government bonds and tax-free investments. Government bonds and tax-free investments, a guide. Government bonds are debt securities issued by the government to finance public spending, while tax-free investments refer to instruments that provide returns exempt from tax. In India, various government bonds and schemes, such as the tax-free bonds and the National Savings Certificate (NSC), offer attractive investment options with tax benefits. The wealthy contribute large sums to retirement accounts like the National Pension System (NPS), which helps them save for retirement while reducing their taxable income. Mechanisms of tax-free bonds and government securities. Wealthy individuals often invest in government bonds and other tax-free instruments to secure stable returns while minimizing tax liabilities. These investments provide a dual benefit of earning interest and enjoying tax exemptions. The legality of tax-free investments in India. Investing in government bonds and tax-free instruments is legal and encouraged by the Indian government. However, individuals must ensure compliance with regulations regarding investment limits and disclosures to maintain eligibility for tax benefits. History of tax-free investments and government bonds in India. India has a rich history of government bonds, dating back to colonial times. Recent initiatives, including the introduction of tax-free bonds, reflect the government's commitment to encouraging investments in infrastructure and public welfare. Tax-free investments. Advantages for the affluent. According to the Ministry of Finance, tax-free bonds raised approximately 40,000 crore in 2021, demonstrating their popularity among investors seeking tax-efficient options. Case studies. Popular tax-free investment strategies. Investing in tax-free bonds. Wealthy individuals often allocate a portion of their portfolios to tax-free bonds, enjoying assured returns without tax liabilities. This strategy allows them to grow their wealth while optimizing tax exposure. Government securities, GSECs. Many affluent investors buy GSECs, benefiting from stable returns and tax exemptions on the interest earned. These investments often serve as a safe haven during market volatility. NSC and PPF high net worth individuals frequently invest in NSCs and PPFs, which offer guaranteed returns and tax deductions under Section 80C, showcasing how tax-efficient investments can be a cornerstone of financial planning. Pro tip: consider investing in tax-free bonds and NSCs, National Savings Certificates, for stable returns without tax liabilities. Inequality in tax-free investments. Challenges for citizens. While wealthy individuals can easily access government bonds and tax-free investments, the average citizen may face challenges in understanding and navigating these options. This lack of awareness can lead to missed opportunities for tax-efficient investing. Emotional perspective. The gap in financial knowledge. Consider the frustration of ordinary citizens who may not be aware of tax-free investment options, while the wealthy capitalize on these strategies. The feeling of exclusion from beneficial financial opportunities can create a sense of hopelessness and inequity in the system. Tax-free investments, inclusive or exclusive? Share your perspective. What are your thoughts on government bonds and tax-free investments as a strategy for the wealthy? Share your views in the comments, and let's discuss how to make tax-efficient investments accessible to all. 11. Retirement accounts and pension funds, maximizing tax savings. Retirement accounts, such as the Employees Provident Fund, EPF, and the National Pension System, NPS, are financial vehicles designed to help individuals save for retirement while offering tax benefits. These accounts encourage long-term savings by providing tax deductions on contributions and tax exemptions on withdrawals. Wealthy individuals split their income by giving assets or investments to family members in lower tax brackets, reducing the overall family tax bill. Mechanisms of EPF and NPS in India. Wealthy individuals often maximize their contributions to retirement accounts and pension funds, leveraging the tax deductions available under Section 80C of the Income Tax Act. By strategically investing in these accounts, they can build substantial retirement savings while reducing their taxable income. Retirement savings, legality and limits in India. Contributing to retirement accounts is legal and actively promoted by the government. However, individuals must adhere to contribution limits and ensure compliance with regulations to maintain tax benefits. The evolution of India's pension system. India's retirement savings landscape has evolved with the introduction of the NPS in 2004 and the EPF, which dates back to 1952. These systems reflect the government's commitment to encouraging financial security in retirement. Retirement accounts, equal opportunity or privilege. According to the Employees Provident Fund organization, over 6 crore subscribers contributed to the EPF in 2021, highlighting the scheme's popularity among Indian workers and the significant amount of money being saved for retirement. Case studies. Retirement accounts in wealth management. High net worth individuals, 8WIs. Many affluent individuals allocate substantial funds to their NPS accounts, taking advantage of the additional tax deductions available. This strategy not only helps in retirement planning but also minimizes tax exposure. Corporate employees. Senior executives often contribute to the EPF and receive employer matching contributions, effectively increasing their retirement savings while benefiting from tax deductions. Self-employed professionals. Many self-employed professionals utilize the NPS to secure their financial futures. enjoying the dual benefits of tax deductions on contributions and tax-free withdrawals after retirement. Pro tip: max out your NPS contributions under Section 80C for additional tax savings, and if employed, ensure you're contributing to EPF for retirement security. Retirement savings disparities, challenges for average citizens. While retirement accounts provide significant tax advantages for wealthy individuals, many average citizens may struggle to contribute adequately due to lower income levels. This disparity can lead to a lack of financial security in retirement, perpetuating wealth inequality. Emotional impact, financial insecurity in retirement. Imagine the stress of working hard throughout your life, only to find yourself unprepared for retirement, while wealthier individuals secure their futures through strategic savings. This feeling of insecurity can be disheartening, especially when financial literacy resources are limited. Planning for the future. Are retirement savings accessible? What are your thoughts on retirement accounts and pension funds as a tool for tax savings? Are they effective for all income groups, or do they primarily benefit the wealthy? Share your insights in the comments, and let's explore how to make retirement planning more accessible for everyone. 12. Family trusts. Family trusts, wealth management across generations. Family trusts are legal entities established to manage and protect family assets. These trusts can help minimize tax liabilities and ensure wealth is transferred efficiently across generations. In India, family trusts are becoming increasingly popular among affluent families for estate planning and asset protection. Family trusts help wealthy families avoid inheritance taxes and protect their assets across generations. By placing assets in a trust, they ensure that taxes are minimized. Mechanisms and benefits of family trusts. Wealthy individuals set up family trusts to hold their assets, which can help reduce estate taxes and provide beneficiaries with a structured way to receive their inheritance. Trusts can also be used to distribute income among family members, effectively reducing the overall tax burden. Legality of family trusts in tax planning. Establishing family trusts is legal and governed by the Indian Trusts Act, 1882. However, misuse of trusts for tax evasion can attract scrutiny from tax authorities, highlighting the importance of compliance and transparency. The historical role of family trusts in India. The concept of family trusts has historical roots in Indian law, but recent amendments and legal interpretations have made them more accessible and beneficial for wealth management. Family trusts, protecting wealth through generations. According to a report by the Estate Planning Institute, nearly 40% of high net worth families in India have established family trusts, indicating a growing trend in wealth management and tax efficiency. Case studies. Family trusts among affluent families. Ambani family. The Ambani family has utilized family trusts to manage their vast business empire, ensuring a smooth transfer of wealth across generations while minimizing tax implications. Prominent industrialists. Many industrialists establish family trusts to hold shares of their companies, allowing for controlled distribution of dividends among family members, thereby reducing individual tax burdens. Wealthy families. Several affluent families use family trusts as a tool for philanthropy, channeling a portion of their wealth to charitable causes while benefiting from tax deductions. Pro tip: creating a family trust can aid in tax-efficient inheritance planning. Ensure compliance by consulting a trust specialist or estate planner. Impacts on average citizens. While family trusts provide significant tax advantages for wealthy individuals, the average citizen may lack the resources or knowledge to establish such entities. This gap can contribute to wealth inequality and limit opportunities for financial planning. Trusts and financial stability. The emotional divide. Consider the anxiety of working-class families who struggle to secure their financial future, while affluent families utilize trusts to protect and grow their wealth. This disparity can lead to feelings of hopelessness and frustration among those seeking financial stability. Family trusts, essential strategy or economic divide. What do you think about the use of family trusts in India? Share your thoughts in the comments, and let's discuss how trusts can impact our financial landscape. 13. Tax credits. Tax credits, how the wealthy use them to save for. Tax credits are incentives provided by the government to reduce the tax liability of individuals or businesses. In India, various tax credits exist, such as those for investments in renewable energy, healthcare, and education, allowing individuals to lower their overall tax burden. The government offers tax credits for things like investing in renewable energy or donating to education. The wealthy use these credits to significantly reduce the taxes they owe. Tax credit mechanisms and their benefits. Wealthy individuals often leverage tax credits to offset their tax liabilities, thereby reducing the amount they owe. By strategically investing in sectors that provide tax credits, they can optimize their tax strategies and increase their disposable income. Claiming tax credits. What's legal and what's not? Claiming tax credits is legal and encouraged by the government. However, fraudulent claims or misinterpretation of eligibility criteria can lead to legal repercussions, emphasizing the importance of accurate reporting. The evolution of tax credits in Indian tax law. The Indian tax system has evolved to include various tax credits as a means of incentivizing certain behaviors, such as promoting investment in clean energy and supporting educational initiatives. Tax credits. Significant savings for the affluent. According to the Ministry of Finance, tax credits accounted for approximately 25,000 crore in revenue loss in 2021, highlighting their popularity and significance in the tax landscape. Case studies. Tax credits in practice. Investments in renewable energy. Wealthy individuals investing in solar energy projects can claim tax credits, significantly reducing their tax liability while contributing to environmental sustainability. Education donations. High net worth individuals often make substantial donations to educational institutions, claiming tax credits under Section 80G, effectively supporting education while benefiting financially. Health insurance premiums. Many affluent families invest in health insurance policies to secure their health and claim tax deductions under Section 80D, demonstrating how tax credits can influence financial planning. Pro tip: look for tax credits for renewable energy or health insurance investments. Tax-saving credits can be claimed directly and reduce your overall liability. Knowledge gap. Tax credits for average citizens. While tax credits offer significant advantages to wealthy individuals, average citizens may lack awareness or access to these opportunities. This lack of information can perpetuate financial disparities and limit access to beneficial tax strategies. The awareness gap. Tax credit accessibility. Imagine the frustration of individuals who are unaware of the tax credits available to them, while wealthier individuals capitalize on these opportunities. This gap in knowledge can create feelings of inadequacy and exclusion from financial benefits. Tax credits for all. Join the discussion on fairness. What are your thoughts on tax credits as a strategy for reducing tax liabilities? Do they provide genuine benefits for all income groups, or do they mainly favor the wealthy? Share your views in the comments, and let's discuss how to make tax credits more accessible for everyone. 14. Wealth management services. Wealth management services, financial planning for the affluent. Wealth management services are comprehensive financial planning and investment services provided to high net worth individuals. These services encompass investment management, estate planning, tax optimization, and other personalized financial strategies designed to grow and protect wealth. The rich hire wealth managers who create personalized strategies to invest their money, avoid taxes, and grow their wealth efficiently. Mechanisms of wealth management in India. Wealthy individuals often engage wealth management firms to devise tailored investment strategies that optimize returns while minimizing tax liabilities. These firms employ sophisticated techniques and in-depth market knowledge to maximize financial outcomes. The legality of personalized wealth services. Utilizing wealth management services is legal and widely practiced. However, individuals must ensure that their chosen firms adhere to regulations and ethical standards to avoid potential legal issues. History of wealth management in India. The wealth management industry has evolved significantly in India, driven by the growth of the affluent class and increasing financial literacy among individuals. Regulatory bodies oversee these firms to ensure compliance and protect clients' interests. Statistics. According to a report by Knight Frank, India's wealth management industry is expected to grow at a CAGR of 15% over the next 5 years, reflecting the increasing demand for personalized financial services among the affluent. Case studies: wealth management strategies in India. Private banking services. Many wealthy families engage private banks that offer bespoke wealth management services, ensuring their financial portfolios are optimized for tax efficiency and growth. Investment firms. High net worth individuals often work with specialized investment firms that focus on alternative investments, which can provide significant tax benefits and enhance portfolio performance. Family offices. Some affluent families establish family offices that manage their wealth, encompassing investment strategies, estate planning, and tax optimization, showcasing how personalized services can be leveraged for financial efficiency. Pro tip: even if you're not affluent, consulting with a financial planner can help tailor saving strategies and optimize taxes. Start by exploring lower-cost online advisory services. Access to wealth management services for average citizens. While wealth management services provide significant advantages for affluent individuals, average citizens often lack access to similar resources. This disparity can perpetuate wealth inequality and limit opportunities for effective financial planning. Perception of wealth management: a resource gap. Consider the frustration of hardworking individuals who may not have access to wealth management services, while wealthier families benefit from personalized financial strategies. This feeling of exclusion can foster resentment and dissatisfaction with the financial system. Wealth management: a service for the few or for all. What do you think about wealth management services in India? Are they a necessity for the wealthy, or can average citizens also benefit from similar strategies? Share your thoughts in the comments, and let's explore how to democratize financial planning for all. 15. Real estate investment. Real estate investment: building wealth through property. Real estate investment involves purchasing properties with the expectation of generating returns through rental income, capital appreciation, or both. In India, real estate remains a popular asset class for wealthy individuals seeking to diversify their investment portfolios. The wealthy invest in real estate not only to earn rental income, but also to take advantage of tax deductions on mortgage interest, property taxes, and depreciation. Mechanisms of real estate investment in India. Wealthy individuals often invest in residential, commercial, or industrial properties, leveraging tax benefits associated with real estate ownership. They can deduct expenses related to property maintenance, mortgage interest, and property taxes, thereby optimizing their overall tax liability. The legality of real estate investment transactions. Investing in real estate is legal, but individuals must comply with local regulations and tax laws to ensure compliance. Proper documentation and transparency are essential for lawful real estate transactions. History of real estate investment in India. The Indian real estate market has seen significant growth over the years, fueled by urbanization and increasing demand for residential and commercial properties. Government initiatives, such as affordable housing schemes, have also contributed to the sector's development. Statistics. According to the National Real Estate Development Council, real estate accounted for 13% of India's GDP in 2021, highlighting its importance as a wealth-building tool. Case studies. Real estate strategies for the affluent luxury residential properties. Wealthy individuals invest in luxury real estate, enjoying tax deductions on property expenses while benefiting from capital appreciation over time. Commercial real estate. High net worth individuals often acquire commercial properties, generating rental income while taking advantage of tax deductions on mortgage interest and maintenance costs. REIT investments. Many affluent investors participate in real estate investment trusts, REITs, which provide exposure to real estate without the need for direct property ownership, offering tax efficiency and diversification. Pro tip: research REITs if direct real estate ownership isn't possible. They allow you to benefit from property investment with fewer financial barriers and tax benefits. Challenges for average citizens in real estate investment. While real estate provides significant tax advantages for wealthy individuals, average citizens may face financial barriers to entry. High property prices and limited financing options can make real estate investment challenging for the general population. Emotional impact, dreams of property ownership. Imagine the disappointment of individuals who aspire to own property but face financial obstacles, while wealthier individuals benefit from real estate tax breaks. This divide can lead to feelings of frustration and disillusionment with the housing market. Real estate for all. Discussing accessibility. What are your thoughts on real estate as an investment strategy? Is it a viable option for all income levels, or does it primarily benefit the wealthy? Share your opinions in the comments, and let's discuss ways to make real estate investment more accessible for everyone. Now that we've uncovered these tax secrets, it's time for you to take action. Whether it's exploring legitimate deductions, investing in tax-friendly accounts, or consulting a financial advisor, you're now better prepared to start building wealth in a smart, sustainable way. Let us know in the comments, what strategy are you most excited to try? And if you found this video helpful, don't forget to like, subscribe, and hit the notification bell. Stay tuned and watch our future videos to dive deeper into strategies for building wealth and mastering your finances. Every video brings you one step closer to financial freedom. Thanks for watching, and we'll see you in the next one.